Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday to take a deeper dive into the markets to see if the waters make any sense. And, well, they don't. But today we had the much anticipated, as with every first Friday of the month, the non-farm payroll report. And as I kind of thought it was going to be, well, a bit disappointing, and it didn't disappoint. So experts predicted 160,000 jobs. Now, why did it disappoint? Because you have to remember, the ADP payroll report came out yesterday, and it was above average. And so all of a sudden you have to say, well, they're not perfectly correlated, but if you get an above average number on one, you might get it on the other. So it came in, not at 100, or experts thought 160,000 jobs, 130,000 actual created. Out of that, a whole bunch of those jobs were made up by the Bureau of Labor Statistics, who is going to do one of the largest one-month revisions, not until next year, of minus 501,000 jobs, because they overestimated between March 2018 and March 2019. So obviously when we'll look at the numbers, and we just can't take them at face value. Also adding to the payroll numbers were 25,000 jobs due to the 2020 census. But going backwards the last 2 months, they removed 20,000 jobs. So what happens is when you get downward revision, so the BLS, they put out it's always an estimate. It's never like the final number. And then over the next 2 months, they revise the prior 2 months. So when you see downward revisions, those are associated with economic slowdowns, contractions, and recessions. That's where you see them. When you're seeing upward revisions, you're seeing that during expansion. So the fact that we're seeing downward revisions and slowing payroll growth, not a good sign. Let's take a deeper dive. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This video is not to be construed as a recommendation or solicitation of buying any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that amount do not reflect the Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let's go right over to my non-farm payroll tab, and you're going to have to just kind of put up with that. What's called OBS is the software I used to switch around, and it's not working right with the browser. I don't know why. There was an update for Firefox, and it hasn't worked correctly since. So here's the official number for the moment, the estimate, 130,000 jobs. Out of that, 93,000 were completely made up by the Bureau of Labor Statistics, leaving a mere 37,000 jobs that they knew for sure. Out of those 37,000 jobs, 25,000 of them, so take this down to 12,000 jobs, because those 25,000 were from the census, and then the prior 2 months were revised down by 20,000. Technically, you got a negative non-farm payroll report. There's no way they're going to put that out, but that is pretty much what happened. Now, as we continue on with this line of thinking, the household survey showed about 500,000 round number jobs created. Now, there's much like many things with the government, they have multiple people. They have, for example, you have the USDA and then you have the FSA. They both are doing the same thing and coming up with different numbers. Well, it's true in the payroll. You have something called the household survey, which estimated 500,000 jobs were added, which is a substantial number. But out of that, nearly 400,000 of those jobs were added were people taking on a second job for economic reasons. Now, that's a big difference between someone taking on a second job because they want it, but economic reasons means, hey, I need the money and my current job is not providing, so I'm taking on a second job. That is not normal in expansions either, because in economic expansions, people don't need to work extra jobs because there's money flowing in and pay raises and all that. In times of economic slowdowns or contractions, recessions, you start to see that. Now, the good news is, out of all of this, wages went up a little higher than expected. I want to say 0.4% over the last month, and non-supervisory went up 0.5%, and that's good. Some people say, well, that's inflationary. It's not. Inflation is when the money supply expands. So let's say I am an employer, you are an employee, and I give you a raise. Now, where did that money come from? Did I just conjure it up out of thin air? No, it had to come out of my business. So instead of the business having a little extra money, the employee has a little extra money. It's not inflationary. It's just shuffling money around. It would be no different than giving money to a child. It's not inflationary. He's like, here, have some money. It doesn't magically poof grow on trees. It doesn't magically expand. It's just moving it from one person to another. So anyone that says, oh, the increase in payrolls or wages was inflationary, it's not. We don't get inflation that way. We get inflation through lending demand. That's where it comes from. All right, let's go back to the PowerPoint. I think I may have said my piece on that. I don't know. We'll see where we go. M2 money supply. This is pretty interesting. The growth rate slowed to 5.21. 3-month rate of change 3.34 and rising. 3-month rate of change is 1.73 and falling. This is really, really low, headed back down toward zero. Then we'll take a look. Let's take a look at commercial and industrial lending. Is now down to 6.5% from a year ago. But what I want to show you, and let me go get rid of that other tab so we can switch over, and there we go, is the consumer industrial loans. Here's the 6.5, the year over year rate. The 6-month fell to 1.5 and the 3-month rate of change 1.2. So you can see this thing is back decelerating again, and this tells you quite a bit. A lot of people right now believe the problem in the world is interest rates are too high. Now, they are, but here's how you tell that it's not, the interest rates aren't the problem. If interest rates fall and lending demand increases, so for example, I go out and walk around my neighborhood and I see homes that are for sale start to close. I see people that have cars for sale start to sell. I go down to the car dealership and I see other people that are buying cars. I see home demand flying. I see lending demand in all kinds of ways, shape, and forms growing, whether it's credit card demand, anything. That means the economy needed lower interest rates. There was pent-up demand, just not at the prevailing rate. When interest rates go down and demand goes down as well, it tells you that interest rates aren't the problem. It doesn't tell you what the problem is. It just tells you that lower interest rates aren't helping. This is real important because right now everyone's got this notion that it's like 2016 again. If we just lower interest rates enough, the stock market will go up a whole bunch and the economy will boom. And so far, we've had 30-year Treasury yields go to their all-time lows. It did not spur any big surge in housing, which is what 30-year yields do, because most people buy homes on 30-year loans. So we know the problem in the economy is not lower interest rates, meaning the Fed is going to lower, or have to lower, I don't know for a fact, any more than they might know, and it's not going to make a difference. That's what we know. All right, let's go back to the PowerPoint. So we see commercial industrial lending falling. No surprise, because lower interest rates aren't causing or are not leading to an increase in demand. And here we go again with consumers. Looking at credit cards and other revolving plans, growth rates falling to 3.87%. So lower interest rates are not helping consumers either. Not at all. Not making a difference. I mean, look, if you look at this trend and go, well, that's a rising trend. No, it's a falling trend. So interest rates have been going down since when? October of 2018. And so is demand. It tells you lower interest rates aren't the problem, or they need to be substantially lower. Let's take a look at the longest losing streak for global PMIs. This is factory PMIs. Investors in the U.S. are so bullish on U.S. equities that global factory data is the worst it's ever been since 1999. Yeah, crazy, right? Now check out this chart. This is non-farm payrolls versus overtime hours. I love it. It's kind of like one of my other charts we'll look at. This was not my words, but whoever posted this on Twitter. Great chart suggesting that overtime hours lead non-farm payrolls by 3 months. It's got a 90% correlation. It's not looking good. Nope, and it's not looking good. In fact, we can go over to, because things are not working in the way they're supposed to work. I don't know what changed in this program, but here we have total construction spending versus non-farm payrolls. We looked at this Wednesday, and I said, look, this is telling us that non-farm payrolls are heading lower. And you can kind of see going back here to, I'll try to keep the mouse pointer to the left so you can see it, going back to 2007, that total construction spending on a year-over-year basis was falling and contracting, and non-farm payrolls went sideways, and then boom, bust. So here we are. Construction spending is falling, or has been falling. Non-farm payrolls are going sideways, which means at some point there's a bust coming here as well. All right, let's get back to that. Close that tab up. University of Michigan consumer confidence present situation. So this is how people feel at the moment, right? So you go, how are you feeling? Their optimism is falling. And what we know is unemployment rate falls as consumer confidence falls. And why does that make sense? See, as investors, it's just not a matter of like, well, that's what that chart says, so that must be how it is. No, act like you're a child. Why, mom? Why, dad? Why? Now think about this. When you're feeling really confident about your finances and where things are going in the economy, what do? You spend money. Right? Hey, I'll go buy a new car. Why? Because I got a raise and I'm feeling really good about my job and business is booming and I really want a new car, so I'll go buy one. Now, what if you're not confident? You're like, man, they're laying some people off around here. Sales are slowing. My own numbers are on the bottom of the totem pole for sales or whatever. What do? You don't spend. And in a debt-based economy, when people stop spending or curtail their spending, what happens to economic growth? It contracts. And what happens when economic growth contracts? What do employers do? You got it. They lay off. So what we see is unemployment rate here is inverted, suggesting that unemployment should start to roll up, because this is inverted, and that makes perfect sense. This is an interesting chart that I wish I could take credit for. So I made one, so I could take credit for it. I forget who posted this on Twitter, but kudos to him, because what this shows is the dollar index in blue and the U.S. Treasury cash balance of the Fed. This is something we've looked at because the U.S. Treasury is low on cash, and they're about to borrow $300 to $350 billion just to refill their coffers, not including the additional money they need to fund the deficits, because deficits are a problem. Governments can run deficits, don't get me wrong. They just need the economy to grow enough to run with it. And when the deficits are growing faster than the economy, it doesn't work. It can work, but not when the economy is in its 10th year of an expansion and consumers are tapped out. So what's going to happen to the dollar is, you can see, is that when the Treasury cash balances, this green line, rise because the Fed or the U.S. Treasury is borrowing money out of the economy to refill their bank accounts, the dollar in blue rises. And when it goes down, it tends to fall. And here it fell, and the dollar didn't go down. Hence, gold is going to get crushed. Now, I did make my own version of this because I actually have the same, I don't have the exact same data, but I don't have a Bloomberg terminal, but I do have the free Fed economic data provided by the St. Louis Federal Reserve. And here you see the exact same information. You see Treasury deposits with the Fed in blue, and look at trade-weighted U.S. dollar. Boom. Now, I know people are like, well, wait a minute, the gold rally, you didn't miss it. Because what's going to happen is this is going to go up, and so is the dollar. Now, why is that going to happen? Well, because there's a shortage of dollars. When you're the reserve currency, people borrow against dollars in foreign countries. Now, we're not used to that here, because when we go down and buy a house or a car and finance it, they don't ask what currency we want to borrow. You want to borrow it in dollars or euros or renminbi or Deutsche Marks or what? No, they don't ask that question. But in foreign markets, large borrowers can borrow in foreign currency. Pretty cool, right? Yeah, until there's a dollar shortage. Did you get it? Dollar shortage. So what happens when the Treasury, again, ask why. What happens when the Treasury goes out to the economy and says, hey, I need to borrow $300 to $350 billion from anyone who has dollars. And oh, by the way, you're going to have to give me the money because the U.S. government cannot shut down. And they pulled all that money out of the global economy. That's dollars that people need. So the value of the dollar goes up. And what generally goes down when the dollar goes up? Gold prices go down. And for all my people who work in the oil industry, you're probably already going, oh, he's about to say crude oil. Yep, you got it. This is going to happen over the next 60 days. It hasn't started yet because we can go back here and look at this chart and we can see it hasn't started its upturn. But when it turns up, the dollar should rally and then all gold and crude oil should fall. This is why I've said this is not the big move in gold. The next move is the big move in gold. This one flushes people out. The next one is the one that comes. Now, where was I going with this? Oh, yeah. So the economy is going to tighten. That's why you want to own bonds. Got it? And then you want to turn around and buy gold because when the economy tightens, when it's real weak, the Fed's going to have to start aggressively cutting. And if the Fed turns back to quantitative easing, which they will, they have no choice. I mean, not tomorrow, not next month, but they will get back there. Then that's when the money multiplier, which we've looked at in its high correlation to gold, tells us that gold prices go bananas. Got it? Good. All right, on to, not that. Nope. PowerPoint. There we go. Back to the PowerPoint. See, I told you this wasn't going to be a boring update at all. Now, I know a lot of people don't think there's going to be a recession. And I'm chuckling here because Fed Chair Jerome Powell spoke today in Switzerland. And and really what's great about social media, especially Twitter, because there's so many financial people on Twitter, is someone asked him, do you see a recession coming? He says, no. And immediately on Twitter, someone's like, well, the Fed's never predicted a recession. They're like, well, they didn't predict the last 18. And all of a sudden you get all these comments about people saying, look, this is hilarious because they will never tell you they think there's a recession. Even though what I'm showing you right here is the New York Fed model says probability of recession 12 months ahead is at 40%. And you go, well, that's only 40%. We'll just round up. Well, it was only about 40% in the dot-com bubble and then during the great financial crisis. So even the New York Fed thinks we're about to have a recession. Now, as far as economic growth, the Atlanta Fed is forecasting a 1.5% GDP growth for the third quarter. That's fairly weak, and you can see the estimates were really high, and now they're falling, and maybe will fall some more before the end of the month. We'll see. And you can see looking at other economic data, truck tonnage index year-over-year change, rolling over and headed down. What's truck tonnage mean? People are shipping less stuff. How about railroad freight? Same thing here. You can see freight traffic year-over-year basis in contraction. Tells you a lot about what's going on in the economy. Who's buying equities? Well, it's not insurance company and pensions. They've been net sellers since the great financial crisis. It's not really households. They've been fairly flat, slightly net sellers. Foreign investors, they do like to buy U.S. equities, but they're selling. It's corporations. Look at that. Boom. Corporate share buybacks. Boom. Who is the biggest buyer of stocks? And they're slowing down. And when they stop, and at some point they will, because they do not have an infinite amount of money, you can guess where the stock market's headed. And that, let me get something we can look at here. And hang tight. There. This is what happens when you don't have this thing going right to the browser tab for whatever reason it is. So looking at liquidity, the NASDAQ McClellan Summation Index has turned higher. Kind of makes sense. The market has moved back up a bit. Let's talk about the ag commodity sector. So everyone's dumping ags again. I don't know who has any left to sell because there's heat. There's heat coming. Now, again, they need 5 to 6 weeks of heat. They don't need this rain, but they're going to get it. And over the next 2 weeks, at the moment, everybody's going to be, wow, that doesn't look fun for us. So, look, another hurricane, another weather change, something can happen real fast. And here you can see there's going to be some more rain coming, and they really don't need that. There already is too much rain. So I want to share with you, I'm thinking we'll hold on to the ags for a few more weeks, and potentially just if this thing doesn't turn around, we'll have to let them go. The great interview, I can't show it to you because it was part of a subscription service, but I'm going to share with you a few things. This guy is maybe the foremost expert in this that I've ever read, and I've read and looked and done a lot of research. So this guy talks about the 11-year solar cycle, how we go from high sunspots to low sunspots, and at the trowel, which where we're at now, they have greater correlations with earlier frost states in the Midwest. Okay, we know that, and we also know of anyone who works in the farming community or has lived in the Midwest, look, yeah, you need 5 to 6 weeks of heat, but a little bit of frost damages crops fast. So he goes on to say that we also happen to be in what's called a grand solar minimum, where we have an overall longer period of lower sunspots. I think I mentioned that as well. He said we've seen a weakening El Nino, which increases the odds of cold weather in the Midwest, something I did not know. He says there's an 18.6 lunar cycle, 18.6 year lunar cycle. That's when the moon oscillates between 18 degrees off the equator to 28 degrees. This guy's pretty knowledgeable, right? He says, and it goes on to say that difference forces the ocean and oceans to move in different ways that impacts weather. Pretty cool, right? There's a high correlation where we are now when we're at this part of the 18.6 year lunar cycle for increased early frost risks. Let's go on to what he keeps saying. So he said one of the issues we had is back in 2012, we had a lot of these same things come up, but in 2012, we have an early planting. He says now we have a late planting and late developing crops, obviously due to all the flooding. And so he mentions about the Eastern Pacific, Arctic, and Western Pacific oscillation, and what he says is they're in a negative phase. I know nothing about this. And they tend to push Arctic air, cool weather into the Midwest. So he goes on to say, like any one of these four things, we got four issues that could drive cooler weather right down the Midwest, would do it. He goes, any two could do it. And he says that right now, all four are in favor, and that's rare. That doesn't really happen. And if we get an early frost and it ruins the crops, he said prices are going higher. So he said, look at mid to late September as a higher risk point when all of these things come into sync and push cold weather into the Midwest. So that's good to know. So it tells us kind of want to hold this position at least, maybe till early next month. And he was asked about in the interview Arctic ice melt. Oh, and this was great. He says, in the years where there's low sea ice during summertime, enhances cold air into the Midwest. And this is when you have low sea ice levels, the ocean in the Arctic absorbs more of the sun's energy. And when we go into the cooler phase of September, October, the eastern Arctic freezes very quickly, but the western stays warm, develops a high pressure system over that region, and helps funnel more cold air in the Midwest. So there you go. That's why we'll probably sit on those for a little bit longer. Okay, back over here. Let me clear some tabs out of the way. Assets and liabilities of commercial banks. You know what? Let me briefly talk about, I was going to rebalance the portfolios, the legacy portfolios, on Thursday. I was waiting for two things. One of them was not conditional. I wanted to see the ADP report, the ADP non-farm payroll. It was better than average. There was that fear that today's report would be better than average because the market really hopped on that and the trade war news. And when the market's moving in a bullish phase, you just got to let it run. You don't want to try to jump in the middle of it. So I said, okay, I'm going to sit out Thursday. We'll see what Friday brings. Obviously, the market was up. Market looks like it's going to try to go up. But when you see what I'm about to show you, you'll see why probably around Tuesday-ish, maybe Wednesday, that whatever this bullish fever is going to probably be done, and why you want to own a lot of long duration bonds. So securities and bank credit increased a whopping $27 billion in a week. Where did we see that? We saw mortgage-backed securities. Bingo. This keeps long-term rates low. Jump by what? 22 billion. Yep, 22 billion. Non-mortgage-backed securities jumped by 14 billion. They cut some of their other securities back here. These are Treasury securities. So here they bought 14 billion Treasury securities, sold some other bonds that are not Treasury securities. Well, must be agency securities. So it's Treasury. This is Treasury other. I don't know what they define exactly other as, but look at their mortgage-backed securities. So banks are buying a lot of mortgages because they have to, keeping long-term interest rates low. What that means, we buy. Let me see. Okay, we already looked at that tab. So let's go. Oh, wow. Time flies. To the charts we go. We'll spend the rest of our time here. Whoops, clear that out of the way. There we go. S&P 500. The only way you can get anywhere is in overnight trading when computer algorithms slam the markets and force them up in overnight trading. Why did we get this big move here? Short selling. I'm sorry, not short selling. Short squeeze. So when you have a market that's been trading for a month and sellers have been right here, what are people going to do? They're going to get up here and sell, and they're going to put a stop loss. If they're if they're short here, they're going to put a stop loss right around this level. Well, if you breach this over in overnight trading, when the market's open, those stop losses are breached, those sellers become buyers, and drive the market up. So what should we expect? We should expect a bullish tone into early next week to try to drive the market higher. If we look, and you see that in the NASDAQ, gapped up. Everything is being gapped up to move higher. And it's all being done in overnight trading. And we see volatility is being crushed. And volatility's support is down here a little bit further. A little easier to see in the volatility ETF, which you will never buy, sell, long, short, options against. You will never do anything with this thing. And you can see it broke the support level, which suggests that volatility's got a little ways further to fall. But what's interesting, you see volatility was down 3% today. The market S&P was up 0.9. So you're getting people that are selling volatility, clearly, and they're not getting paid for it. Which means they're going to try to push this a little further, and then they're going to get shorts. They're going to get squeezed out of their short positions because at some point buyers will come in and short the market or buy volatility or do something. So let's take a look at 10-year Treasury yields. Came up and hit resistance at 1.6%. I think I may have mentioned that the other day that I was thinking they were going to get there. Hard rejection. Not going to be surprised if they make another run at it at all. Looking at 30-year yields, they got up here in overnight trading to 2.1. Also got rejected. Again, I'm not going to be surprised if there is a run into early next week to push bond prices higher. And if we look at the TLT, we can see it came down, hit support here, bounced up, but it wasn't a super strong bounce. Would not surprise if it rolls down, confirms again, because the 50-day moving average is rolling up. And it doesn't have to come up and touch this exactly, because we've seen where it kind of starts to take off and the 50-day rolls into it. So this is a nice pattern. And that's where we switch the short-term bonds, which are about to reconfirm their 50 days. This is what I think that why interest rates could go up a little bit, is you could see short-term bonds come down to the bottom of this support range, hit the 50-day moving average, confirm it, and go. And that means the ZRAs, the 25-year zero coupons that we want to swap for, going to come down a little bit probably. That's what we look to buy. We know the banks have got our back. We're good to go. Let's take a look at emerging markets, a signal of, that's not the word I'm looking for, a proxy for liquidity. And so we see, again, markets trying to drive liquidity higher in hopes of trade war ending. It's not going to, and it's coming up here to its 50-day moving average where it failed to cross. It's got its 100-day curving down, 200-day flat. What does this mean in emerging markets world? Well, when you've got downward trending moving averages, prices will come up somewhere along the way and reconfirm them. Not there, it's not a good look, but you can see kind of down to here, they'll come down and hit up here, and they'll follow this. Now, if we get a break through this shaded line, that is going to be a liquidity purge, and stock prices will sell off. They will go. Let's take a look at the ags. We're seeing some pickup in volume here. I mean, there's really I don't know how much more bad news you could throw at this sector. But China's pretty much stopped buying new crop, but they're buying our old crop, go figure, and they're desperate for food. And then you've got this little heat wave maybe over the next weeks, but that could change. We saw how quickly that actually changed due to Hurricane Dorian. So maybe something else shows up and pulls the weather. I mean, or those four things I went through. Anything can happen now and drive this higher. How much time do we have left? Oh, we're pretty much out of time. Gold is getting reversed. We can see the mining stocks getting sold here. Again, I suspect as the dollar rallies, this gets flushed out. We'll look and see how the hedge fund managers are positioned. Let's take one last look at Apple, because they really are telling us where the broad market is. They're sitting in this heavy sell zone that's been sell, sell, sell. If the market is going to break out, Apple needs to get through 215 and go. Continue selling here tells you, look, I know Apple's got $200 billion in cash, but at some point you see stocks get sold. So anyways, let's wrap up our update. We'll be back Monday, and we'll see what the hedge funds managers are up to. We'll look to rebalance the portfolios next week ahead of the Fed meeting in a week and a half, ahead of the Treasury getting ready to do their big borrowing, and also starting the following week, corporate share buyback blackouts hit the 75% level. Probably look at that on Monday if I remember. I'm Steve Van Metre. Yeah, something like that. Have a great weekend. Bye now.